Hello, greetings from Mehek. Well, what brings me here today is to discuss about understanding financial statements that every business manager needs to know. So let's have insights about this insightful topic through Amer Qureshi, who is a well-renowned business consultant and has already guided so many businessmen. Hello, Amer. How are you doing?
Good, thank you. Thank you very much for having me.
Well, Amir, I have been obsessed about the topic that is related to financial statements and why should non-finance managers also need to know about financial statements in businesses? Tell us about this.
Well, that's a good question and good place to start. I suppose everyone who's working in a business or in an organization which involves money coming in and going out needs to have a good understanding of finances and accounting. And people who are having a management position within organizations, within companies, need to have a really good understanding of financial statements because they're involved in all kinds of financial decisions. Sometimes they have to develop budgets, sometimes they have to set pricing. So everyone who's involved in business needs to have a good understanding of basically finance and accounting.
I get it. That's that. So, what could be the key financial statements and why do they matter? Like, you can just tell me about the three key financial statements and why they are important to be understood.
Yeah. So the three main financial statements that we talk about, although from a management perspective, there's a lot more we can discuss, but the three basic financial statements that every company produces as part of their annual reporting or regular reporting is the income statement, which shows the profit or loss the company is making, which is essentially income minus expenses. The second one is the balance sheet or statement of financial position, which shows you what the company's financial position was like at a particular date, usually the financial year or the end of the month. So it's at a given point in time, and it has the assets, liabilities, and as a result, it shows you what the net entitlement of the owners, effectively their equity is in the business. And the third one, which is very important also, is the statement of cash flows, which shows how much cash the business generated, how it was used, and what the cash balance at the end of the period is. So all three are very, very useful. And sometimes managers don't pay enough regard, for example, to the cash flow, whereas, and maybe too much emphasis on profitability. So both are extremely important, but cash flow is what ensures the survival of the business in the long term.
So, Amir, what is the most common mistake that managers oftentimes make while reading financial statements?
So many of the managers, unless they've had some grounding in accounting and finance, don't really understand the basics. So my advice to non-finance managers is to get some basic training so they understand the statements that we've talked about and they understand the impact of their decisions. So sometimes they will make decisions without really knowing the consequences. So let's look at a practical example. There's an end of quarter or end of year coming. There is a lot of pressure to drive up sales. So everyone pushes and pushes and gets the sales up. And they meet their targets, and maybe if their commissions or incentives linked to those sales, they are actually paid out to the employees. However, sometimes just because you've driven the sales up doesn't mean the customers are going to pay on time. Sometimes maybe we force them to buy certain things which they didn't really need. They may start returning those things. So we have to have one eye on the cash flow. We have to have the second eye on the profitability. So both have to go hand in hand. We cannot just focus on driving sales because we also have to then look at collection of those sales as well.
Yeah, I think that's perfect. Well, I it just came into my mind that how can managers use financial data for better decision making?
So if we put financial statements to one side, inside the financial statements, there are a lot of key performance indicators or KPIs for short, as we like to refer to them. It could be things like the margins that you're making on your products, or how long it takes before you sell a particular product, which is your sometimes called the inventory turnover. We could look at number of days it takes to convert a sale into cash, which is the receivables turnover, as it's called. So we have all of these KPIs that managers need to be monitoring on a regular basis to make sure that the business is going in the right direction. And they have to have this basically dashboard where they track these financial indicators to make sure they're on track. The other interesting thing is that if you're a manager who's managing a portfolio of products, you need to be across which are the most profitable products, which are the products which are doing well from time to time. You need to look at the pricing. You need to make sure that you're making enough margins on those products, and because that's what will drive profitability in the medium to long term.
Perfect. Perfect. I think you have enlightened the topic very well, and I believe that it is quite enlightening for the viewers as well. Extending my heartfelt gratitude for your time, Amer, and to the viewers for giving us their time. Hope to see you again with some new topic. Have a good time. Thank you.
Thank you.